Welcome to this explainer. We're diving right in today because we're going to dissect the mechanical economics of wealth. We're exposing the foundational illusion of the modern financial system. You see, if you put the global financial structure under a microscope, you quickly realize something, well, pretty alarming. The system was actually never designed for you to accumulate true wealth just by saving your money. Wealth isn't just some magic number you hit. It's a mechanical architecture you build. Let's look at exactly how that architecture functions.
So rule number one, we absolutely have to break the illusion we've all been taught. We're conditioned, right? We're conditioned to think that accumulating raw cash in a bank vault equals safety. But here's the reality check. Holding onto raw cash is actually a structural trapdoor. It's definitely not a wealth-building mechanism. Honestly, it's the single biggest architectural trap in modern economics, and everyday investors fall right through it while just trying to do the responsible thing. Consider this structural reality for a second. Most people think getting rich is about hitting some specific, massive number in a savings account. But the ultra-wealthy, they know a secret that everyday savers completely miss. When you deposit cash into a retail bank, you aren't actually protecting your money in a vault. Legally, you're becoming a creditor to that bank. You're literally letting them borrow your hard-earned liquidity for pennies, all while inflation and the drag of taxes silently eat away your purchasing power in the background. Simply put, you are losing while the asset owner captures all that cash flow.
Section 1. The liquidity deception, the hidden mechanism of the banking system. This brings us to what's known as the spread. This is the clinical, totally hidden mechanism that banks use to multiply your deposits. See, when you store your capital in a traditional savings account, the bank doesn't just sit on it. Oh no. They take your deposit and immediately multiply it using fractional reserve banking. They deploy your cash right into high-yield commercial loans, corporate debt, real estate, vehicles that generate immense cash flow. And what do you get in return? A tiny, tiny fraction of a percent. Meanwhile, they keep that massive, highly profitable margin entirely for themselves.
And this really perfectly illustrates the holding cost of static capital. There's this massive gap between inflation spikes and average wage or savings growth. Think about it. Your money is being actively penalized by inflation while it just sits there, literally working to build someone else's balance sheet. The economic system is hard-coded to reward the entity controlling the asset, the bank, in this case, while systematically punishing the person holding the cash. Bottom line, if your money is sitting still, it's working for someone else, period.
Section 2. The Physics of Wealth. The Law of Capital Velocity. So this naturally raises a pretty pivotal question. If traditional saving is just an architectural trap designed to fund someone else's assets, well, how do the elite actually compound their wealth? I mean, what are the mechanisms the top 1% are using to engineer their net worth entirely outside this traditional system?
The crucial point here is incredibly simple. Velocity is greater than accumulation. While the middle class focuses entirely on, just saving up a static pile of money, the ultra-wealthy focus exclusively on the speed and movement of their capital. Wealth isn't a stagnant pond, it's a rushing river. You absolutely have to keep that capital moving to avoid the friction of inflation and taxes.
Let's break down this brilliant three-step structural loop the elite use. First off, they rarely earn massive traditional salaries because W-2 income gets hit with the absolute highest tax brackets. Instead, step 1, they route their capital directly into appreciating assets. Buy. Step 2, they borrow. They take out low-interest private corporate lines of credit against those assets to fund their lifestyle. Now, because borrowed money is legally classified as debt and not income, it triggers exactly 0 tax liabilities. And finally, step 3, die. The wealth compounds completely untouched by the tax code. The asset grows, the cash flow services the debt, and their entire system completely bypasses all that economic friction. They aren't richer because they have more cash. They're richer because their system is vastly superior.
Section 3. The infinite output, decoupling time from scale.
Okay, let's pivot for a second from capital over to human labor. The scale factor here is literally everything. You simply cannot build asymmetric, life-changing wealth by trading a linear unit of time for a linear unit of currency. It's mathematically impossible, guys, because human labor only has 24 hours in a day. You are a non-scalable asset if you're only relying on your physical time. To get true economic leverage, you absolutely must decouple your operational input from your financial output.
Think of this gap kind of like the collapse of traditional physical retail spaces. Malls didn't fail because people stopped buying things, right? They failed because a physical footprint couldn't possibly compete with the borderless, zero marginal cost scale of digital systems.
Fixed hourly wages operate on that exact same flawed brick-and-mortar logic. They just cannot compete with the infinite scale of systems and code that are out there working around the clock. Wealth flows directly, and I mean directly, to those who utilize these specific types of leverage. You've got capital, which is basically using other people's money to acquire businesses. You've got software, using code to automate distribution globally at practically zero extra cost per unit. And then you have media, building a borderless audience that consumes your content while you're fast asleep. Leverage is that magic ingredient. It's what allows your operational input to stay completely fixed while your economic output scales exponentially.
Section 4. The open loop, the mathematical consequence of structure.
So the ultimate takeaways here are pretty crystal clear. Cash is a structural trap that essentially turns you into a poorly paid creditor. Capital velocity mathematically defeats linear accumulation every single time. And your output? It absolutely must be systematically decoupled from human time through leverage. Becoming rich isn't some reward for just working harder within a broken framework. No, it's the mathematical consequence of building a much more efficient structure.
Once you actually understand this foundation, your very next step in the architecture of wealth is mastering phase 2. This is exactly how the global elite use debt as a literal offensive weapon to expand their empires, all without triggering a single tax event. It is a completely new paradigm of understanding how money works.
So look at your own life right now. Really think about it. Are you building a scalable leverage system, or are you just serving as the cheap liquidity that's powering someone else's? It might just be time to start rethinking the architecture of your own wealth today.